Okay, so why would you put down less than 20%? So if you're someone that's looking at it from the perspective of, I want to put down 20% because I want to avoid mortgage insurance, right? And you're coming to the table with that mindset to begin with, and you really haven't answered any other questions financially other than, I don't want to pay mortgage insurance, right? And this is how I'm attacking the market. And I've got 20% down in my budget and I'm going to avoid mortgage insurance, right? I'd say not a bad idea, but without the actual comparisons of 10% down, 15% down, 5% down, 20% down over a range of price points as you're looking at the market to become a homeowner, depending on your market. If you're in Massachusetts where inventory is tight, you kind of want the widest available web of inventory if needed. And then in other areas where there's massive amounts of inventory and it's a little bit different from a buyer seller's perspective, maybe you can be very narrow and say like, this is, I got plenty of options for real estate. So, I can be narrow with my goals here. So my goal when I'm chatting with a client about this topic is always from the standpoint of looking at two levers. The two levers we're looking at are, well, it's three levers, but the two levers we're looking at in this category are how much money am I spending out of pocket to acquire real estate? So down payment and closing costs, right? And then what's my total payment after I buy the property? Understanding that the details matter of like, well, what's the buckets of interest, principal, taxes, insurance, HOA if I'm getting a condo, mortgage insurance, right? What are my closing costs? All the buckets matter, but the buckets only matter in the conversations of trying to get nuance to fit within a bigger scope of once you spend a certain amount of money out of pocket to buy property, you have a payment, right? Cause and effect, chicken and egg, chicken, right? Like it's pretty straightforward. Spend the money, half a payment if you're getting a mortgage, if you're not buying cash, right? Now, where I go with, is it worth it sometimes to do less than 20% down? And how I handle it with clients that come to the table thinking that from the jump. I don't say that it's a wrong idea. I just ask, what have we looked at to determine that that's actually the best structure for you in relation to the house you're buying, right? Because maybe you're looking at an $800,000 house in a town that an $800,000 house is done. You don't need to do anything to it other than regular maintenance, and you can move in and you're going to account for your regular maintenance, replace the water heater every 10, 20 years, right? Like it's pretty much solid and modern enough and you're going to enjoy living in it. The kitchen's nice, the bathroom's nice, the roof is decently new, the yard's trimmed and well put together, the siding's nice, the backyard's nice, everything's nice. You don't really need to do anything other than it's like buying a nice car with a clean Carfax. You're still going to need to do brakes, tires. You're going to get some things in dents. You're still going to take care of the car, change the oil, do all that fun stuff. But it's a good car, right? You're not having to go in and have the engine rebuilt right away, right? So you're good to go. So you're buying the equivalent of a good, solid car for a house, right? You want to account for all of that. Now, where I go with my clients to say, okay, let's run that number. Let's run that as your control, right? The top tier of the perfect move-in ready house available in your market. Again, particularly in Massachusetts because inventory is tight. My goal when I'm talking to clients and realtors is how do I help clients face the needs of today's market, and the needs of today's market circle right around how do I look at more inventory, right? Because inventory is tight for single family homes in Massachusetts in neighborhoods. It's tough, competitive. You've got to win the market to get those houses right now. So where I go with clients there is to go, you've told me a certain number that you're comfortable with for a payment, and we have a certain range of budget availability for price points based on your market of towns that you're looking at and the types of homes you want. And then you have a certain amount of money to work with in terms of how much you can spend out of pocket to buy real estate, right? And this is where I think the rubber really meets the road of what would be a good reason to not do 20% down and pay mortgage insurance when you have the money available to do it, right? And it's the arena of can I open up more inventory, look at a less desirable home to a degree or another, but the price reflects it. So if the $800,000 house is the top of the line model in your market of like, if I'm buying an $800,000 house in this market, I'm getting a good house, right? But what does a $650,000 house look like that needs a new kitchen, needs some sprucing up in the bathroom, isn't complete tear down, but is that scenario of like, hey, this is a really good car, it's a great frame, but it's got some engine issues. If someone rebuilds the engine, the car is great, right? And you're going to get the car at a discount because the engine needs to be rebuilt. If this engine was rebuilt, it's a $30,000 car, but because the engine needs to be rebuilt, it's a $15,000 car. But it's only going to cost you 5 grand to bring it to a mechanic and rebuild the engine. So if you're willing to take on that sweat equity position, you can walk in with equity, right? That's the area I go of where does it make sense to do it, where it's just almost kind of a no-brainer, right? If that makes sense. And the math I do with the clients is let's look at the 650 house. And can you spend a little less out of pocket to buy the house down payment wise? Bring in mortgage insurance in your payment, but maybe your payment threshold is still well below your comfort range because again, your comfort range is the $800,000 house with 20% down. What if we look at the 650 house with 10% down compared to 20? You got some wiggle room because we're getting it for less than the 800,000. So you can go up a little bit in the payment in a vacuum compared to 650 with 20% down and 650 with 10% down. Yeah, that math makes more sense in a vacuum, but we're not doing vacuum math for each house because we're attacking the market as a whole and what's available for inventory, right? So if you're looking at the $800,000 houses that are move-in ready, but it's competitive and you're making offers and not getting them, and then you're looking at the $650,000 house that has, avocado kitchen, the salmon bathroom, the wood paneling in the basement, the bones are good, but it needs someone to come in and put some capital into it to get it to that $800,000 range, maybe 100 grand worth of capital. We do the math slightly different, do less down, earmark some of the money that you had set aside for the $800,000 perfect house with 20% down, and we split that however which way we split it. And now you're doing 5% down on 650. So now you have all of the rest of that money that you had available for your 20% down payment to avoid mortgage insurance on the perfect house that you can spend to renovate the not perfect house. You're still spending house money on a new home. It's just not all going directly to instant equity. It's going into a different equity bucket called sweat equity because you're buying it and now you're hiring a contractor, cutting them a check. Look, we have a new kitchen. Your house is worth more, right? Look, we have a new bathroom. House is worth more again. Look, the HVAC's replaced. More. We did the yard. Worth more, right? You're not seeing that instantly in the mortgage insurance, but that's why we do the holistic math of is there a way to buy the fixer-upper, still not increase your expenditure total out of pocket for your budget that you've set aside to buy a house, right? Let's say that's 150,000. So how do we, within the budget of 150 to put down, have you put down 5% and now free up the rest of that capital to invest in sweat equity? And is the payment outcome still within your budget, even inclusive of mortgage insurance? Because maybe we do mortgage insurance as a single premium and you pay it once, you don't pay it monthly, right? So that's one scenario where I think it makes sense that have an open mind of why would I pay mortgage insurance if I don't need to? Because again, in a vacuum, the 650 house, if you put 20% down, no mortgage insurance, yay. But now you have a house that you still need to fix up, that maybe you won't even buy it because you need to fix it up because you're doing the math of, well, if I spend my 20% down to avoid my mortgage insurance, I don't have money for a fixer upper. So I only can look at the done houses, right? And if that's the case, your inventory is more narrow. And if inventory is already an issue, that's not really a good viewpoint of succeeding in the marketplace, right? If that makes sense. Now obviously you have to be open to a fixer-upper, and not everyone is open to a fixer-upper. So if you're not open to a fixer-upper at all, then, unfortunately, if you're in an area like the Northeast where a lot of homes are older, you're going to be stuck in that upper end of the price points that it's usually the most competitive because people don't want to take on other people's headaches, right? Like I do that analogy of the car. How many people are really willing to take on a car that, the engine needs to be rebuilt, right? Some people are looking at it like, I barely understand what my mechanic tells me when I get my oil changed, right? Like I'm not doing that. So it takes a certain person to view it that way, but it's a good starting point to start looking at the mortgage math numbers of using the right structure of a financial instrument of debt to create a certain outcome, right? Don't come to it perfectly square peg, square hole based on what you're Googling and what someone on TikTok told you, right? It's more nuanced than that because it's more, well, what's available in my market? What can I buy and afford? What's the competition look like? How can I structure my mortgage debt so that I can go achieve my goal of wanting to buy a house in this town that I like, right? Don't come to it with, well, I read online that mortgage insurance is evil. Okay, well, that's not helping you achieve the goal. It's just telling you that you think mortgage insurance is evil, right? But yeah, you get no benefit from mortgage insurance other than less percentage down. In terms of like actual material insurance that you're paying for, that's all for the lender. That's all for if you don't pay, we have an insurance policy that we can get some of the losses back before we have to foreclose. It's not really a big tangible benefit in terms of what you're paying for. So I understand the logic of like, I don't want to pay for it, but you got to look at it holistically. That if what it helps you achieve is less down, because then we're the lender looking at it like, hey, if we didn't have mortgage insurance, you would have to put 20% down, right? That might narrow your buying pool. So the fact that it's there and available and it's at your disposal to use as a leverage in the marketplace to generate an outcome, that's how we should look at it. Not that it's evil, it's a leverage point that if you have 20% down, but you're thinking, all the houses I'm going for, I can't get because it's competitive. And I'm seeing these other houses that aren't selling because they need some love and they're sitting on the market. Maybe there's an opportunity there, but then you start doing the math at 20% down. You go, well, once I do my down payment, I don't have money for a kitchen, right? You got to back out and go, okay, if I'm getting a discount on the property for the work that needs to be done, the payment's going to be less. Is mortgage insurance that bad? Because if you have good debt to income, if you have good credit, and you're using conventional financing, mortgage insurance, depending on what you're putting down for a down payment, is a movable target. It's based on the full profile. So yeah, if you're putting 3% down and you have high debt to income and you have an okay credit score, mortgage insurance is going to look awful, right? If you're getting FHA financing has a table that the mortgage insurance is set based on your down payment percentage. And, it's not really based on your credit score or anything like that. So it's just a set amount based on your loan amount and down payment percentage. That might not look that great either, right? Depending on what you're putting down. But if you're in the bucket of 5% down, 10% down, 15 with good credit, low debt to income, and a good position in all those other categories, mortgage insurance might not be as daunting as you think. You might look at it and go, I just ran a scenario for a client the other day. The mortgage insurance was like $60 a month, right? And they were like, oh, that's not even that much money. And then I ran a scenario of doing a single premium. The single premium was $3,000. So it went from 20% down, no mortgage insurance to, well, what if you did 15% down and then we did the mortgage insurance as a single premium? I'm going to save you 5% of your down payment. And in a vacuum, the payment's going to be relatively the same because we're shifting, the mortgage insurance from a monthly premium to a single premium and maybe paying a little bit of discount points to manipulate the rate. But now I've earmarked you 30 grand extra in terms of down payment, right? So you should be having those deeper conversations with your lender about the actual impact to your total payment and what you're spending out of pocket and your goal to the property instead of just, I don't like mortgage insurance. It's a good starting point. Do the homework, but make sure you do that next level of homework as well.